Good morning, everyone. It's good to see so many people turning out. There was, I think, 80 people at 7 o'clock in the morning learning about exploration in Nevada. This is probably the best speculative investment conference that's out there in this space. And I'm so happy to see that people are not at the casinos speculating or buying lottery tickets. They're exploring opportunities in the mining world. So I'm going to quickly speak about the macro forces that are impacting the markets based on a lot of math, a lot of regressional studies, and I'm going to go quickly because I have 15 minutes. So when we look at the world of macroeconomics, you try to look at big factors, and it's so important to look at a binomial model. And this model is the government policies are a precursor to change. And there's always a battle and a tension between monetary policies and fiscal policies.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
And as you can see here, that monetary policies are rising interest rates, and right now we have the unwinding of QE. And that's having tremendous ramifications, the unwinding. It's good for gold bugs because it's less than the debt level, but it's very disruptive to the stock market. The volatility of the stock market has increased dramatically with the unwinding of QE. And it's also sucked a lot of cash out of the system that would normally be going into markets, and the cost of money is going up rapidly. On the positive side, President Trump did push through lower taxes, and that helped keep the economy, but the trade wars are significant. Why are the trade wars significant? Well, let's take a look at macro factors. Chindia, affectionately known as China and India, is 40% of the world's population. 40% of all consumption you got to think of, and this is where the GDP growth rate is twice what the G7 countries are. And the other key factor when you look at macro numbers is the GDP per capita. And what was significant was when the GDP per capita of China surpassed the US. And you can see here where these numbers are showing you, look at China, America, and India. 1, 2, and 3, when we're looking at purchasing power parity, there's a significant consumption. And this is very important for the love trade, for the consumption of gold. It's also very important for travel, why I launched the JETS ETF, because you're seeing, if you go to New York City in front of the New York Stock Exchange, you will see dominated 50% of the tourists are Chinese tourists. You're seeing real estate throughout the US all of a sudden appreciate with Chinese buyers. So when we talk about these macro forces, trade wars, why the trade war? Why has it been so unsettling to the macro markets? Well, if you look at the GDP of China and the US collectively, they're 40% of the world's GDP.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
Two nations at war over trade. And all the US government is saying is that we have a $14 trillion economy and China wants to sell to it, but if we turn around and sell back to them, they have tariffs on us. So we like zero tariffs. That's the real battle. And it's important to recognize not the narrative from the media, but really what's drilling down, and he believes he has muscle, he has power to turn around to influence the Chinese to drop the tariff war that they've actually created because the barriers to entry of going into China are asymmetrical. They're asymmetrical for the Chinese always want to come in to sell or acquire companies in America, but American companies cannot do that. And then we have this other macro force that's important to recognize. The global debt has reached $244 trillion. And it's important to recognize this is a significant factor for gold. Now, suppression of gold, it's always this big argument, but we've seen since gold peaked at almost $1,900 and QE3 came in, all of a sudden gold did not move with money, with debt increasing around the world, in particular in the US. Why was that? And then we see all of a sudden there was lots of price manipulation and litigation that's basically exposed this spoofing of the market by the major banks. Now, it's temporary, they cannot do it permanently, but the spoofing is real, and it's in particular when China's on holidays in the first week of October, and then we have the Chinese New Year is another time of all of a sudden price manipulation comes into these markets, and if you're smart about it, it's your buying opportunity. And we've seen this happen with Bitcoin. I've never seen a bull market and a bear market all happen within a year. I mean, it was just spectacular to watch the G20 countries, the finance ministers, collaborate and do everything and synchronize attacks on Bitcoin and cryptocurrencies around the world. So you can see if they can short-term suppress the price of gold, what takes place, what can happen when all of a sudden it's not developed. The Bitcoin world, the crypto world is not even close to the depth and historical significance of gold. So gold will always be there, but this is something that's growing, and the digital money and digital world is not going away. And that's one reason why I launched Hive blockchain, and I've had many questions on Hive. And so let me share with you with Hive. Hive correlates 94% of the time for the past 3 months, and for the past year, it correlates 92% of the time with the price of Bitcoin and Ethereum. So it has become a proxy. It has become the go-to in the stock market. If Bitcoin is up, we jump 15, 20% and we trade 4 million shares. So it's like a gold stock that trades, most gold stocks trade off the price of gold. Now what's happened with Hive blockchain, it trades off the direction short-term of Bitcoin and Ethereum. So the capital markets are broken. I thought this was very humorous that Bloomberg magazine put this on their front cover of perception versus reality. But what's important is after 2009, the excessive regulations has had a big impact on hedge funds, mutual funds, the formation of capital, even junior mining. The cost of IPOs in the US since the year 2000 is off 50%. So it's important to look at government policy as a precursor to change and to look at regulations. Every year we publish this piece of looking at the rotation of the commodities, and historically it's always best to take a look at what's on the bottom troughing. Usually they elevate and rise to the following year to the top end. This is the most popular piece that we have on our website, and we get tens of thousands of people downloading it. So I urge you to go to usfunds.com and look at it, and you get an idea that no commodity stays at the top or the bottom for any extended period of time. So we look at the year 2000, Sarbanes-Oxley comes out, and all of a sudden we start getting more and more regulations. And what's interesting when you look at the big picture is that bullion has outperformed the S&P by a massive margin. Not a little bit, but a massive differential. But still, the major media outlets are always negative on gold. Whatever it is, but here it is proven long-term, short-term as a great asset class. And I think it's also important to recognize with the excessive regulations, we've seen a 50% drop in IPOs in the US. And so you would think if there's less companies outstanding, more companies buying back their stock, the S&P would actually have done much better, but it hasn't. So gold has become a very important part as an asset class. So why China? We come back to this rotation of macro factors because China is 50% of commodity demand. It's just foolish not to follow these macro factors such as India is 40% of the world's population and consumption every day. And then you have the US and China is 40% of the GDPs of the world. And what happens when they're in synchronized and there's a love and harmony versus battle? What does that do? It's very disruptive, and you can see it show up in what's called Purchasing Manufacturers Index. GDP is looking behind us. PMI is looking in front of us. PMI is Purchasing Manufacturers Index. If you were a manufacturer of copper of engines, that means if you get a lot of demand to make more engines, you're going to consume lots of energy, consume lots of copper, steel, whatever the metal is, to make these and deliver them in 6 months. So anytime we see the 1 month above 3 months, it's usually a bullish signal. And when it goes below, it's a bearish signal. And it's a great forward-looking indicator for anyone in the commodity world. So what's happened with global PMIs? As you can see here, they peaked last April, and when the trade wars, the rhetoric started picking up, that was the peak. And all of a sudden, we started seeing this contraction. Even though the stock market was still rallying, it was ignoring this. PMI has now proven out that the stock market unravels 6 months later. So what's the data? Data. And that's what's so important for you all to recognize how the collection of data and the synchronization of data, looking for patterns, looking for anomalies, looking for something that has a momentum to it is so important. So we could take simple macroeconomic data points, and if the 1 month is above the 3 months for the PMI, and it does it for 3 months in a row, that means commodity demand is picking up, and it usually runs for 9 months to 18 months at a time cycle. Vice versa, when month goes below 3 months, it's time to build cash and watch your investments, because the wind is now all of a sudden is going to be in your face. It's not going to be in your back. And that's what's important when we're looking at macroeconomic forces. And usually the pivot point takes place like 2008. We're now seeing China all of a sudden flooding money into the system. They're doing everything to try to spur their economic activity, and we're seeing copper all of a sudden start to rise. We're seeing copper go above its 50-day moving average. We're seeing the price of oil. We know gold is already above, and it looks like gold is ready to go above its 200-day, which means the trend is your friend and more people come into the market. So peak gold. Peak gold is real, and peak oil was real until innovation with the frackers came along. But there has been no innovation in this space, and only Superman can see through rocks, and he has difficulty with lead. So it's important to recognize that you need to have innovation, you need to have technology. It's so important, and that's one reason why I made an investment in a company called Goldspot. And it all has to do with they're using data mining. They're using the latest of technology, artificial intelligence. And Canada, you should be so proud of, is the premier nation for AI. Microsoft is hiring 5,000 people in Montreal. We're seeing more and more in Toronto, more and more breakthroughs on applications of artificial intelligence to look at data sets. So we have to recognize this is an important part. CapEx has been slowing going into the mining sector, in particular gold, but GDPs per capita in China and India, which is 70% of gold demand, the love trade, they continue to buy. So there's an interesting dynamics of supply demand that you've got to be very bullish on gold. And we can see that China continues to add to its reserves. And then this past 9 months, we've seen a pivot change with countries like Hungary and Poland, all of a sudden their central banks becoming major buyers of gold. And Turkey turns around to try to manage their currency, which got unraveled about 9 months ago. And they basically sold the gold, and it was quickly bought up by Poland. And then after they stabilized their economy, Turkey's come back and been buying more gold for their central bank. So we're seeing more and more central banks, and that's an important macro force to look at. So this idea of quant investing, it's so important to recognize that mutual funds are going in the space. The hedge funds that are actually growing and not shutting down, they are using quant applications, data mining sets. And they're the ones that are so important in driving 70% of today's day trading is not high-frequency traders, but it's high-frequency research. And that's what's important for you to appreciate what drives and how they look at sentiment, and they look at word choice and press releases. So to help everyone in this room, the difference between deduction and induction. It's important to recognize that a deductive thinker like Sherlock Holmes versus Dr. House, these sort of the inductive thinking. And this is what machine learning is about. This is what artificial intelligence is, more about induction. I have a hunch. And it doesn't give you a zero trial balance. It gives you a high probability, like Alexia and voice recognition and finding the data for you when you ask a question. And eye recognition for the new iPhones to be able to facial identification. All these parts are basically getting better and better with machine learning and artificial intelligence. So as I repeat, when we do a zero trial balance, you do the Excel sheets, you're looking for something precise and concise, whereas machine learning is looking for probabilities and approximations. And because of the advent of the cloud, it's allowed this change. And one of the big factors is sentiment. How do you feel? And then how you look at how you feel is the words you use in your vocabulary. And this is collected by Facebook and everyone else. Now all the quant funds are collecting the data. They're collecting the filings with the US government and immediately processing. They can read 7 annual reports in 1 minute. 1 minute. No portfolio manager in the world can do that. So it's important, this news factor is driving a lot of the short-term volatility in the capital markets. And you see some of these movies, if you haven't seen Moneyball or 21 or Beautiful Mind, I highly recommend you go to Netflix. You see these movies because this is how things are changing. And coming back, that's why I launched GoGo in Canada, a smart beta gold ETF, and it outperforms the iShares, it outperforms the GDXJ 90% of the time going back over 10 years. It's a quant approach. It took me 8,000 hours of regressional work to be able to come up with this type of product. And that's what's important to realize. That's how things are shifting. So with that, I want to thank everyone for coming out so early in the morning to recognize these macro forces which are taking place and recognize that the quant world is changing. It is changing everything we do. And you have to respect it and be curious about it. Delve into YouTube. There's lots of great videos for it. And I want to thank all of you for being such happy investors in an incredible challenging cycle. Thank you.